Is the latest market news showing a stock in a rapid falling trend, flashing massive sell signals? Or is this actually a strong buy that some are, calling an undervalued AI goldmine?
Yeah, it is basically the ultimate market Rorschach test right now.
Hmm.
I mean, depending on the metric you prioritize, you either see a brilliant corporate pivot or, well, a catastrophic retail value trap just waiting to spring.
Right. Welcome to this custom tailored deep dive. Our mission today is to completely unpack what might be honestly the most chaotic corporate transformation of the year.
Oh, absolutely.
We are looking at Allbirds, the company famous for those comfortable, sustainable merino wool sneakers. They trade under the NASDAQ ticker BIRD, and they are abruptly abandoning footwear to pivot straight into AI compute infrastructure.
Which is just a massive leap.
It really is. And if you want to help us out on that mission to decode this madness, please hit the like button, subscribe to our YouTube channel, and it is compulsory to leave comments with your feedback. We really need to know exactly what you think about this wild situation.
Because right now, the market is just entirely divided. But we also need to be crystal clear before we go any further.
Oh, right, the disclaimer.
Exactly. What you are about to hear is a natural human debate. We're exploring the facts, the numbers, and the mechanics of this transformation. This is strictly not financial advice.
Definitely not. We are just analyzing the mechanics of a market event, not, telling you what to do with your portfolio.
Right.
Okay, so let's unpack this. The core facts driving this absolute frenzy are these. Allbirds is entirely exiting the footwear industry, like completely done.
Done with shoes.
Yeah. And they are rebranding the entire corporation to NewBird AI. To fund this, they are selling off all of their footwear intellectual property and their physical retail assets to the American Exchange Group for roughly $39 million.
Right, $39 million.
And in its place, this new entity, NewBird AI, is relying on a separate $50 million financing deal. And that's to purchase high-performance GPUs and lease them out to AI startups. I mean, a wool shoe company pivoting to high-performance AI data centers. It's crazy.
That's like a local bakery suddenly deciding to pivot to uranium enrichment.
That is, honestly, the absurdity of that analogy actually captures the mechanical reality of what they're attempting here.
You think so?
Oh, yeah. Pivoting to GPU leasing isn't just like buying a bunch of fast computers and plugging them into a wall. It is like deciding to become a high-tech digital landlord.
Okay, explain that a bit.
Well, you are buying the most expensive, power-hungry apartment buildings on Earth, these massive server racks, and your entire survival depends on keeping them leased to AI startups 24/7 without, the local power grid melting down.
Wow. Yeah, that's a huge shift.
It's massive. You are going from managing global supply chains of wool to the highly specialized, incredibly capital-intensive world of thermal management, network architecture, and digital compute power.
And the market's reaction to, a bakery enriching uranium is exactly what you would expect. Complete, unadulterated pandemonium.
Pure chaos. Let's look at the actual quote and the trading history from just the past 24 hours to understand how the market is attempting to price this thing. Because today is April 16th, 2026.
Right.
And the latest price, as of midday, is $11.90. That is down a massive 30.13% today in a very high volatility falling trend.
Yeah, but that 30% drop is meaningless without the context of the preceding 24 hours.
Fair point.
Because yesterday, April 15th, following the initial news of this AI pivot, the stock had a staggering 582% surge.
Which is just unheard of.
Right. It peaked at $16.99.
Mm.
And if you look at it, the 52-week range for this stock is practically a canyon.
Yeah, let's talk about those numbers.
The 52-week low was sitting all the way down at $2.15. I mean, that was a company deeply struggling to sell shoes.
Right.
And then the 52-week high of $24.31 was hit during the absolute peak frenzy of yesterday's incredible rally, just before gravity started pulling it back down.
We have to talk about the sheer volume of shares changing hands here, too, because it defies logic for a company of this size.
It really does.
By midday today, we have seen over 22 million shares traded. And yesterday, during the initial surge, a record 276 million shares traded.
It's mind-blowing.
For a company with a market cap hovering around $100 million, 276 million shares means the entire float of the company turned over multiple times in a single trading session.
What's fascinating here is the underlying mechanics of that kind of volume. That's not just, retail traders logging into their brokerage apps and buying a few shares.
Definitely not.
Volume at that scale is driven by algorithmic trading systems chasing momentum triggers, combined with a massive short squeeze.
Ah, the short squeeze.
Exactly. Think about all the institutional investors who are betting against a failing shoe company. Suddenly, the ticker attaches the letters AI to its name, the price rockets upward, and those short sellers hit the panic button.
So they have to buy back in.
Right. They are forced to buy back shares at any price to cover their positions and avoid total ruin, which basically acts like pouring gasoline on the fire.
Which brings us to the divided order flow. Because if you look at social sentiment platforms like StockTwits, retail traders are the ones buying heavily today.
They are diving in.
They are seeing the letters AI, looking at yesterday's $24 peak, and experiencing extreme fear of missing out at $11.90.
Oh, the FOMO is real.
But on the flip side, institutional selling is heavily suspected anytime the price pushes past that $15 or $16 level.
And this is the psychology of the cooling off phase we are seeing today. When you have a meme stock surge of 500% or more, institutional investors who are trapped holding a dead retail stock suddenly see like a miraculous exit window.
They're jumping ship.
Exactly. They realize the fundamental value of the company hasn't actually increased by 500% overnight. The narrative has just temporarily warped reality.
Right, the fundamentals are the same.
So they take that liquidity and run. They are essentially using the retail buying pressure as exit liquidity, systematically offloading their bags to retail traders who are buying into the hype.
Wow.
And that organized selling pressure is what creates the high volatility falling trend we are watching today.
So if institutions are aggressively dumping their shares while retail traders are eagerly buying them up, we really need to look under the hood at the financials.
Definitely.
We need to see who actually has the better read on the situation. We need the legacy reality of this company before they decided to slap AI on the door.
Yeah, and the trailing 12 months and the Q1 2026 data paint a very stark picture of why management felt this drastic pivot was their only option for survival.
Let's hear the numbers.
So looking at the income statement, revenue has steadily fallen to $152.47 million.
Ouch.
Yeah, that is a sharp, painful decline from the $254 million they pulled in just 3 years ago in 2023.
So the core business was just bleeding out.
Completely. The net loss over the trailing 12 months is negative $77.28 million.
Jeez.
And when you translate that to the individual shareholder level, it is an earnings per share of negative $9.47.
Wait, hold on. Let me stop you right there, because the fundamental disconnect here is staggering.
It really is.
They are losing $9.47 per share, but the stock is currently trading around $11.90.
Yep.
That implies the market is pricing in a massive immediate turnaround that the balance sheet simply doesn't support.
The balance sheet absolutely reflects that underlying strain, too.
Yeah.
Total assets sit at roughly $109.4 million against total liabilities of about $73.5 million.
Okay, so a little bit of a cushion there, but...
But the true killer, the metric that institutions look at first, is the operating cash flow.
Right.
It is sitting at negative $55.1 million.
Yeah.
That is the actual cash going out the door every single year just to keep the lights on and the inventory moving.
And here's where it gets really interesting, because there is a glaring mathematical contradiction in their forward guidance to shareholders.
Oh, the dividend thing.
Yes. They are currently burning $55 million a year in operating cash flow, but they are promising current shareholders a special dividend payout from the $39 million sale of the shoe assets in Q3 of 2026.
Right.
How does that math actually work? If you are bleeding $55 million and you receive a one-time payment of $39 million for selling off your core intellectual property, there is no surplus.
No, not at all.
There is a massive deficit. How do you pay a special dividend out of a deficit?
You don't. The math is incredibly strained, and you have hit on the exact reason the institutional money is likely heading for the exits right now.
It's just a smokescreen.
Pretty much. The promise of a special dividend is highly likely a psychological mechanism designed to keep current shareholders from dumping the stock en masse during this chaotic transition.
That makes a lot of sense.
Fundamentally, that $39 million from the American Exchange Group is going to be evaporated almost instantly. It's going to existing liabilities, severance packages, and the legacy burn rate of unwinding a global retail operation.
So there's no money left for data centers.
Exactly. The only way NewBird AI actually survives to build a data center is through that entirely separate $50 million financing deal that's specifically earmarked for the GPUs.
Wow. Okay, so given these incredibly messy fundamental financials, a shrinking revenue base, a massive cash burn, and a dividend promise that looks mathematically impossible, let's shift to technical analysis.
Let's do it.
Maybe the charts can help us understand the short-term weakness or strength.
So if we break down the technical indicators, starting with the 14-day relative strength index, right now it is sitting at 37.82.
Okay.
Normally, a number approaching 30 indicates a stock is entering oversold territory, suggesting it might be, due for a bounce.
But the context of yesterday's surge completely warps that reading, doesn't it?
Completely. Prior to this week's rally, the RSI was near oversold simply because the shoe business was a failing entity, slowly grinding downward.
Right.
Now, that RSI number is highly skewed by the extreme mathematical anomaly of jumping nearly 600% and then violently crashing 30%. The formula is just struggling to process the volatility.
Makes sense. What about momentum?
Similarly, the MACD, which measures the relationship between two moving averages to gauge momentum, is at negative 0.043.
Meaning the historical trend before yesterday was decidedly bearish.
Exactly. The MACD shows a deeply entrenched bearish trend that a single day's massive surge simply hasn't had time to technically normalize.
Right.
The moving averages themselves are practically useless right now. Think about how a moving average actually works. It is an anchor tied to the past.
Yeah.
Standard technical models are flashing hold signals right now, but they are doing so purely because the current price of $11.90 is so far above the 50-day moving average of $3.29 and the 200-day moving average of $5.75.
Because yesterday's violent spike doesn't magically pull those anchors up overnight.
Exactly.
The mathematical models simply can't keep up with the narrative shift. But traders are still watching key levels, aren't they?
They are. They're looking for floors and ceilings. For key support levels, you have to look way down the chart.
How far down?
Well, the critical floors are $4.57 and $3.33, which were the original pre-meme price levels before the AI announcement was even made.
Wow. That's a long way to fall.
If the current retail momentum breaks and panic sets in, that is the void it could free fall into. On the upside, the key resistance levels traders are trying to break through are $17.06, and that ultimate peak of $24.31 from yesterday's absolute frenzy.
Right.
This raises an important question. Do technical support and resistance levels even matter when a company's entire asset class, its product, and its industry change overnight?
That is the ultimate paradox here. Technical analysis relies entirely on historical price action to predict future human behavior.
Yep.
But there is zero historical precedent for this ticker as an AI compute company.
Not at all.
The past data is analyzing the psychology of people buying comfortable wool sneakers. The present data is analyzing the psychology of people speculating on high-performance server racks.
Which are two totally different things.
Exactly. Trying to connect those two data sets is like trying to predict the weather by looking at a cookbook.
Which is exactly why the professional analyst community is treading very, very carefully.
So let's look at what the professionals actually think. With the technicals completely detached from reality and the fundamentals in a state of, total transformation, we need to debate if this is genuinely an undervalued opportunity in the AI space or a highly dangerous value trap for retail investors.
Well, the current analyst consensus is definitively hold/reduce. Out of the professionals actively covering the stock, there are 0 buy ratings, 2 hold ratings, and 1 firm sell rating.
0 buys, wow. And what is their target?
The average price target from those analysts is $8 flat. That signals a distinctly negative short-term outlook, representing roughly a 32% downside from where the stock is trading right now at $11.90.
So let's actually debate the two sides of this coin.
Sure.
The bear case, which heavily aligns with that $8 target, argues that the stock is wildly overvalued anywhere above $12.
And the logic there is brutal, but grounded in reality. The legacy business, the actual tangible brand and IP of Allbirds, just sold for a mere $39 million.
Right.
Yet the market cap of the shell company left behind is hovering around $103 million.
It doesn't add up.
The bears are entirely focused on the massive downside risks of execution. First, you have the extreme volatility we've already discussed. Second, you have a legacy management team with absolutely zero documented prior experience in operating hyperscale data centers, negotiating industrial energy contracts, or managing complex GPU clusters.
Which is a massive red flag.
But perhaps the most dangerous element of the bear case is the high risk of retail traders getting trapped by massive dilution.
Oh, wait. Let's pause on that because the $50 million financing deal to buy the GPUs isn't just a standard bank loan, is it?
No, it is convertible financing.
This is the trapdoor.
It is the ultimate trapdoor. Convertible financing means these lenders are giving NewBird AI $50 million in cash right now, but they retain the right to convert that debt into new shares of the company later on.
Which means
If the stock price spikes on the AI hype, the lenders can convert their debt, instantly flood the market with millions of newly minted shares, cash out at a massive premium, and dilute the retail buyers who bought at $15 down to absolute pennies.
that's brutal.
It is a classic Wall Street mechanism where retail traders absorb all the operational risk, while the early financiers secure a guaranteed, highly lucrative exit.
Wow.
Plus, the bears argue that pivoting out of sheer desperation, rather than expanding from a position of strength, is universally a red flag.
But 276 million shares didn't trade yesterday just because people were bored.
True.
There is a bull case here, and they are pointing to a concept called AI optionality.
Ah, yes. It is the single most lucrative phrase in modern finance right now.
The bull argument hinges on the fact that if this $50 million GPU play actually works, NewBird AI could be significantly undervalued compared to established peers in the AI infrastructure space.
Oh, without a doubt.
Some of those pure-play data center companies trade at astronomical multiples. Furthermore, they have captured this bizarre first-mover shoe-to-AI meme status.
Which counts for a lot these days.
In today's attention economy, virality is a literal currency. They now have a massive cash injection, a completely clean corporate slate once the shoe assets are fully liquidated, and a highly recognizable ticker symbol.
You also cannot understate the sheer, desperate demand for GPU compute power right now in the broader tech sector.
Everyone needs it.
Every AI startup is starved for hardware. If NewBird AI can somehow navigate the logistics, acquire those high-performance GPUs, and actually get them online, they will have clients lining up down the block.
Right.
The revenue generated from GPU leasing is notoriously high margin and reliably recurring.
So the bulls are just looking past all the mess.
Exactly. The bull's looking past the messy transition and essentially saying, we don't care about the shoes. We just bought a $100 million lottery ticket into the single most lucrative high-growth sector on the planet.
So what does this all mean?
Right.
When you stack the bear case against the bull case, the contrast is almost violent. The best case scenario is a lucrative, high-margin recovery where they successfully pivot, lease the hardware, navigate the convertible debt without massive dilution, and become a genuine player in AI infrastructure.
Right.
But the worst-case scenario is a rapid continuation lower, where the operational execution fails, the convertible debt holders flood the market with new shares to salvage their capital, the stock dilutes essentially to zero, and the retail traders who bought the hype are left holding an empty bag.
It is a purely binary outcome. There is no middle ground for NewBird AI. We are going to witness either a spectacular corporate reinvention that gets taught in business schools or a highly publicized, messy bankruptcy.
Okay, let's bring this all together into actionable timelines so you know exactly what to watch for as this saga unfolds over the next few months. What does the short-term perspective look like?
The short-term perspective, looking at the next few days and weeks, is going to be defined by sustained high volatility.
Buckle up, basically.
Yeah. The market is essentially trapped in a holding pattern, waiting for that critical $50 million funding round to officially close in Q2 of 2026.
So until then,
Until that cash actually clears the bank and the purchase orders for the GPUs are publicly confirmed, every tiny piece of news, every rumor on a message board is going to cause violent swings in the share price.
and looking further out to the medium and long term, specifically looking past Q3 when that supposed special dividend from the shoe sale is scheduled to hit.
The medium to long-term outlook remains that this is a high-risk lottery ticket.
Right.
Success depends entirely on their operational ability to execute a profoundly complex business model from scratch. Can they secure the physical data center real estate?
Can they negotiate the massive energy contracts required to cool these GPU clusters?
Exactly. And crucially, can they actually deliver that final cash payout from the footwear liquidation to keep current shareholders pacified during the long, expensive build-out phase?
There's a lot of ifs.
It is a monumental execution challenge with zero room for error. If we connect this to the bigger picture,
hmm
what does this bizarre, drastic transformation actually tell us about the broader market environment we are trading in right now?
Well, it tells us that we are firmly entrenched in an era of pure narrative economics.
Absolutely.
The fact that a company can announce an exit from physical retail, slap the letters A and I onto their corporate letterhead, and instantly generate hundreds of millions of dollars in trading volume speaks volumes about market psychology.
It really does.
It shows the sheer, overwhelming power of the AI narrative to completely override traditional fundamental analysis. Investors are so desperate to find the next undervalued AI play that they are willing to entirely overlook negative operating cash flows, massive operational risks, and the threat of severe dilution.
It really is a testament to the fact that right now, AI is the ultimate magic password for instant liquidity.
But magic passwords might unlock trading volume, but they do not build data centers. Execution does. And that is where the sheer uncertainty of NewBird AI's future lies. They have successfully changed the narrative and captured the market's attention. Now they have to actually build the machine.
The market is currently pricing in the dream. But eventually, and inevitably, the market will demand the reality.
Which leaves us with a final provocative thought for you to ponder as you watch this ticker symbol bounce around over the next few months.
Let's hear it.
If a struggling, cash-burning shoe company can raise $50 million overnight just by uttering the letters AI, are we looking at the brilliant democratization of tech infrastructure, or is this the ultimate flashing warning sign that the AI bubble is finally about to burst?
That is the multi-million-dollar question.
Thank you for joining us on this deep dive into the chaotic world of NewBird AI. Remember one last time to hit that like button, subscribe to the channel, and drop a comment down below with your read on the situation. Is this an undervalued infrastructure gem or the ultimate retail value trap? We will see you on the next deep dive.